Welcome to BARR Financial Services market commentary for the first quarter of 2011. I have some exciting news to share with you. Recently, the magazine Orlando Home and Leisure has rated me a 5-star wealth manager. And I'm to be featured in the May issue of Forbes as one of the top firms in Florida. We're very excited and we will share more about these accolades at a later time. My wife Darcy has reminded me that I still put my pants on the same way as before. U.S. equity markets continued to climb during the first quarter, but had its volatile moments. As indicated by the graph, the S&P index climbed 5.9% for the quarter, the best first quarter in over a decade, but showed volatility during the quarter. This is a good start to the year and a positive sign considering the major happenings during the quarter, such as the onset of political upheavals in the Middle East and the earthquake and subsequent tsunami that devastated Japan. The strong performance brings the stock market rally, which started March of 2009, to an overall growth of the S&P of 104.5%. and is just 8.5% below the peak reached in October of 2007. There are many, including myself, that believe we could reach these levels by the end of the year. Of the last 10 recessions, the average bull market run lasted 68 months, with an average increase of 176%. As mentioned in our prior commentary, rising oil prices clearly represent a potential risk to global economic growth and the ongoing bull market in equities. Much of the recent rise in oil prices can be attributed to an increased event risk premium added to markets by investors and speculators based on the widening turmoil in the Middle East, rather than a change in real supply and demand dynamics. My expectation is that oil prices should come back down when geopolitical risks ease up. Of course, no one knows when that might happen, meaning that short-term risks will likely keep oil prices elevated for now. Equity valuations seem reasonable relative to expected growth in corporate profits and dividends, and in comparisons to prevailing interest rates. Current PE ratios versus the 20-year average shows that large cap and growth equities are undervalued and there is opportunity for growth. This is important as we hold strong positions in these areas. The forward PE ratio of the S&P index most recent reading of 13.1 times is well below the average of 16.5 times. Again, suggesting stocks are undervalued and have room to grow. This is a reflection going back 17 years to 1993. According to the results of the Business Roundtable's Economic Outlook Survey, the CEOs of America's leading companies anticipate higher sales and plan to increase capital expenditures and employment over the next 6 months. Cash on corporate balance sheets has continued to rise, now accounting for almost 30% of current assets. This is the highest level in over 50 years and puts them in a strong position to benefit from the continued economic expansion. As indicated by the graph, real gross domestic product, GDP, for the fourth quarter of 2010 was 3.1%. compared to the 20-year average of 2.5%. GDP for the first quarter is estimated at a dismal 1.8%. The lost output during the Great Recession has been fully recovered, indicating that the economy is once again in an expansion phase. The big question is at what rate of growth? The Conference Board's leading economic index, LEI, for the United States continues its vertical climb and increased 0.4% in March. This indicates a strengthening business condition in the near term. The Coincident Economic Index, CEI, a monthly measure of current economic conditions, also continued to rise. Ken Goldstein, an economist at the Conference Board, stated, The U.S. LEI continues to point to sustained economic growth through year-end. Political stalemate. The U.S. government narrowly avoided a shutdown earlier this month. Some forecasters worry that the fight over the rising debt ceiling will create more resentment and cynicism. Nonetheless, I feel certain that an agreement will be reached and there will be no default by the Treasury. The rising national debt is one of my biggest concerns over the long term. The government now borrows 42 cents for every dollar spent. One reason the two parties can't find common ground is they can't even agree on what caused the high deficits. They just keep blaming each other, and together they have raised the debt limit 10 times over the past decade. Employment. Stronger than expected job growth in March signals the recovery is finally gaining some traction. Then hiring was broad-based. The net increase of 216,000 jobs in March followed solid gains of 194,000 in February. The unemployment rate dipped a tick to 8.8%, the lowest since March of 2009. Not all the recent employment developments are bright. The number of people working part-time who want full-time positions didn't even budge. But it would seem that we're heading in the right direction. There is no denying that the first quarter was a harrowing one. Yet financial markets have managed through the bad news, and this impressive resilience can be attributed to the underlying strength of the global economy. The economy has turned the corner. Although the pace still isn't what it should be, a healthy index for consumer spending, exports, and business spending is evident. In my opinion, odds still favor continued growth in the global economy, but the unexpected events of the past quarter underscore the need for vigilance. We could see a repeat of last year, with the market surging towards year-end. There remain various sources of volatility and downside risk, including disruption of oil supplies, the European sovereign debt woes, inflation worries, the ever-increasing debt ceiling, uncertain employment growth, economic implications of the disaster in Japan, and other geopolitical risks. Our portfolios performed well during the volatile quarter, and I firmly believe that the diversification of our investments will continue to be beneficial as we move forward into the uncertain future. Please forward this commentary to your friends and family so they can benefit from this information. As always, let us know how we can better serve you and your needs. Thank you for listening and your continued support.